Good morning. It's Thursday, June 13th, about 6 a.m. Central Time. Overnight, the precious metals are getting slammed after yesterday's wild trading session. If you saw the Metals Minute yesterday, I discussed a valuable trading lesson where if you have two separate, extremely volatile events, such as CPI in the morning and an FOMC announcement later in the day, two events in the same day, if you see the average true range being met in the direction that you are trading on the first data point, and you are uncertain as to what the outcome of the second is, it's often prudent to tighten up stops, actively risk manage, reduce those positions. So within an hour of the CPI data release, gold futures rallied $30 on the day, while silver gained about $1 within 90 minutes of trading, leaving short-term traders to question whether or not the risk versus the reward makes sense to hold in what has been a recently hawkish Jerome Powell. So the Federal Reserve Open Market Committee, they voted to keep interest rates steady, while now forecasts only imply one interest rate cut by the end of 2024. If you remember going back to December, it was 6 interest rate cuts. Then you go to March, it's only 3 interest rate cuts, and now it is just 1. So part of the challenge that the Fed is really facing is the labor market strength. The labor market strength helps keep the economy strong, and it keeps inflation high. So that is why beyond central bank buying in gold and the inflation data, employment data such as initial claims, JOLTS, wage growth, productivity, unemployment rate, and non-farm payrolls should be on every gold trader's radar. Every month you should have a list of these things, the dates that they come out, what the expectations are, and then you can look for the adjustments that are made, and then you track that along with your chart pattern, and you can see how strong this market is. Gold futures should continue to maintain an upward pressure as those types of data points deteriorate over time because of the inverse correlation. Now, it is very essential to know what impacts the markets you're trading. So for instance, just an off-the-wall one, like the grain markets, you're going to monitor supply, demand, USDA reports, crop progress, planting intentions, the US and South American weather, the dollar, and then also US-China relations. If you trade crude oil, for instance, you'll want to look at OPEC production, US production, the strength of the US economy, EIA data, API data, geopolitical tensions, Chinese demand, and inflation expectations. Remember, crude oil is the best in the leading indicator when it comes to inflation. The first place people find inflation is at the gas pump, then at the grocery store, then your utility bills and everything else. It's not just gold where prices go up. Gold futures tend to perform the best in stagflation, where inflation is rising and growth is declining because the Federal Reserve is trapped and cannot continue to raise rates. So today we're going to see more inflation data such as PPI, core PPI, and then also the initial claims number. I'll be watching the initial claims number quite closely, and then also that PPI, because of the fact that if the purchasers their inflation data goes up, you're going to see that trickle down to the consumer. So oftentimes it's a leading indicator for that. Now the technicals, besides last night's just slaughter on the open and this liquidation, and you could tell where it's coming from, if the liquidation occurs around the Chinese Open, chances are it's Chinese traders that are liquidating right now. Why are they liquidating? They're having problems again with their property sector. They're having problems again where central banks are not buying. They've over-speculated in some of these metals markets. A lot of their metals are having limit-type moves on their opens that trade on different exchanges. So other than that, if you look at the August gold contract, it looks constructive for the bulls. The market does need to retrace the June 7th sell-off. So if you print off a chart, you look at that Friday, June 7th, where we sold off $72, we've got to go back above that in order to break out to the upside, in order to attract new buyers in. You will have dip buyers come in, but when you go into a trading range, into a consolidation, people don't have that same commitment to the particular underlying market, whatever it is, and they trade the range. So now if you look at a stock like Apple, it was in a trading range. That's what they were doing. The dip buyers were coming in, goes up, they sell it out. Now it breaks out to the upside. Now everybody comes in, they're chasing Apple. Do we own Apple? Does our fund manager own Apple? Things like that. So if you look at the gold market again, from a proprietary trend discovery signal, it went from a neutral trend, which is where it was consolidating around. It had that breakdown on June 7th, that sell-off, created a bearish trend on the gold market. People don't want to hear that, but that's what an unbiased technical system does. And then it says that on the next trading day, once the signal is met, if it opens lower and takes out those lows, that's where the signal is validated. Now, the problem is, as you go to the next trading session, market rallied back up a bit, 2,300 held, so it's a false signal. So we are mostly in a neutral trend right now in the gold market. I may, if we get back to unchanged or get positive on the day, recommend to our clients 2,300, 2,250 put spreads. Cheap insurance policy for people. People like to have insurance. You don't drive around with your car without auto insurance. You live your life without health insurance. So you buy those put spreads as protection against those longer term positions. Now, if you look at the gold market, stochastics are rising a bit from oversold territory. They've got to come out of that oversold territory, which they are attempting to, but they've got to rise out of it. DMI plus needs the crossover DMI minus. Oftentimes you get that as a small leading indicator on the technicals, and something to always watch is the average true range on your charts, which is $38 a day. So right now we sold off about $38 on the low end. We'll see if we could snap back. We do have a lot of data coming out. Now, the silver market, silver maintains a bullish trend as long as it maintains a close over 29.14 according to my system here. That if we close below that level, the trend neutralizer point will be hit, and we will also close below, coincidentally, the 50-day moving average. So it might have some more price pressure to the downside as people use these stagnant archaic systems like a 50 crossing over a 200, which drives me nuts. So looking at the silver market though, down $1 here today. Low end on the range on the July silver got down to 28.90. We are at 29.26, so big jump up here after that big sell-off. But stochastics have declined into oversold territory. The average true range is $1.14. So a little bit longer video here. It's just important that whatever market you trade, if it's cocoa or whatever, just know what impacts that market, and if you don't follow the fundamentals, have a very systematic technical system that has risk management embedded in it. So you got any questions, give me a call, 312-858-7303. Remember, futures and option trading does involve risk of loss. May not be suitable to all investors. Good luck, good trading.